Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts for the show. Joining us today is Foram Parekh of Indiabulls Ventures, Dharmesh Kant of India Nivesh Securities, and Senthil Manikandan of Newberry Capital. Thank you to all of my guests for joining me. Today on Hot Money, we ask our analysts for one stock they believe will post strong results in the upcoming earnings season, which starts tomorrow with TCS and Infosys. We ask them one large cap stock that they're betting on for a 1 year time frame. We talk about Escorts, whether it's worth accumulating at these levels given the fact that tractor sales haven't been that good, and Delta Corp was one of the few companies that have already reported their numbers. We asked their view whether it's worth accumulating Delta Corp at this point of time. But let's start with the first one. Result season officially start tomorrow with Infosys as well as TCS declaring their numbers. I'm sure all of my guests must have had their Excels worked out in terms of which are the sectors and stocks they believe could pretty much outperform this time around. So Dharmesh, as a house, which stocks do you believe that will surprise on the positive side in the upcoming earnings season?
I think on the sector front, it is FMCG which will surprise. It has been doing well and it will continue to do well in this earnings season. Metals and PSU banks. So these are the three pockets where we are expecting a good robust set of numbers coming out for Q4. So in this basket, I think the safest play as of now, sensing all the volatilities in place, would be FMCG sector.
Okay.
In FMCG, we think Hindustan Lever will again continue to post a robust set of numbers, 10% plus kind of a volume growth, with 2-3% kind of a blended realization uptick.
Okay.
So 13-14% on the top line, and operating leverages coming into play, and they have managed the expenses very well. So costs they have totally taken into account, and this time copra prices and other input prices were lower for this quarter Q4 which went by. So there will be a margin accretion of around 150 to 200 basis point on the EBITDA front, operating level. So that will give enough elbow room for HUL to again embark on an upside trajectory as far as prices are concerned. So valuation we do find comfort in HUL. So given the fact that it posts an ROE of 70% plus, at the same time historically it has traded at 65 to 70 PE multiple 1 year forward earnings. As of now it is trading at 45-46 1 year forward PE multiple earnings. So there is a comfort of around PE getting re-rated post Q4 earnings. So we have recommended our clients to buy it. At every fall we have been recommending them. We are also holding this stock in our advisory portfolios. And my own sense is that FY21, if we give it a PE multiple of around 60, so 2100 will be the price target. So it's a buy from
So what gives you the confidence? What's going behind this working of this 10% volume growth?
Yeah.
Have you observed some trends? Have you read somewhere? Have you interacted with the management?
Yeah.
What's the sense? How come are you estimating a 10%?
So initially couple of years back, what was the theme was Patanjali will eat into the market share. So that has not happened. Patanjali is having its own market share, and in fact the market has grown up. That again corroborates the view that rural and semi-urban income has gone up. So 7th pay commission, farm income getting raised, and all this DBT which the government has done has really worked well. So 2 rupees, 5 rupees sachet kind of a thing which used to sell, sold into rural areas. That is the area where volume growth is coming on rather than price realization. So this was again seconded by the management whenever we had interacted with them. So this theme is likely to play. Monsoons, it's too early to come to any conclusion on that. This year monsoon El Nino and effectively there. So last 4 years monsoons have been almost at par. So that has again helped the case of HUL. So consumption theme, quality, and everybody having his own market share, the fear of Patanjali now getting evaporated is a thesis behind we recommending HUL.
So would that also flow into companies like a Marico or Dabur?
Yeah,
Dabur had a lot of issues in terms of, or a Colgate with Patanjali eating this thing. So is that you are bullish on the entire sector that probably this time around the numbers will be on the higher side?
Yeah, entire space look very attractive. Dabur was a direct competition from Patanjali. If you look at Dabur, the type of products they were offering, and Patanjali, both were on the same platform. So there was a direct nexus between the two. But now even Dabur is coming out of the wood. So we do think this entire space, Marico, Britannia, and there's Nestle, all will do well.
Okay, so FMCG as a theme is something that Dharmesh and India Nivesh Securities like at this point of time. and HUL is something that they are betting on. Foram, what are you all betting on? What have you told your clients that watch out for these companies in the earnings season?
Yeah, so we also second to what Dharmeet said. Like we also feel FMCG company, despite reporting very good set of numbers and having a higher base, would continue to give higher volume growth. And we feel that Marico is one amongst the good FMCG bets that y'all can take, because if we look at Marico, the stock haven't rallied much when the entire FMCG stocks were rallying. And secondly, if you see, management is also guided for a strong Q4, and management did hint that volume growth would be in the range of 8 to 10%, which is very healthy. And we feel that of course, like what he said, raw material prices have also come down, which would aid to the EBITDA margins as well. So EBITDA margin increment is definitely on the cards. Bottom line growth should be there above 15%, which is again very healthy. And this is all on a higher base, so it gives us a confidence that yes, the macros are very stable. If we look at the monsoon also, I mean, yeah, we had an extreme summer, we had an extreme winter, so we feel that El Nino effect would be little slim, and that's what monsoons are also expected to be on a better note. So that again augurs a very good demand from the macro side. In particular, if you look at Marico's, rural spending has been more than the urban area, and they feel that there is little whipsaws in the traditional side of sales, but then the modern sales and the online sales are doing good, and we have a lower base in the online sales segment. So I think it's growing at just 3%, and then they expect it to grow in double digits. So there I feel there is going to be a shift from traditional side to the online side, which would again augur to the top line good. So we are very positive on the entire FMCG space. But why Marico? Because valuation wise, if we see, it is trading at a discount to its market leader HUL, and that is where it gives us a comfort that yes, there is room for good upside from here on, and that is why we feel that 420 rupees on the cards is definitely there.
And valuation wise, you are comfortable with?
Yeah, because when you look at Britannia, when you look at HUL, they are all trading at good more than 50 P on FY20 basis, and if you look at Marico, it's trading at 40-45 times, so we still have the discount towards market leader in the valuation side, and that is why I think Marico would be the only growing company which is available at an attractive valuations and not commanding a premium valuations. If you look at Dabur has like attractive valuations, but again the growth is not there as compared to what Marico has. Same is the case with Imami. So I feel that amongst the growing space and the company which does not have attractive or rather premium valuations, Marico is the one which you should go for, which has growth and not premium valuation.
Okay, what about you, Senthil? Which stocks or sector you feel that you should watch out for in this season?
So the chemical space and the specialty chemical space, like companies like Viniti Organics and Aarti Industries, should perform in Q4 and also over the next 2 to 3 years. And within this space, we like the amines companies like Alkyl Amines. If you see for the 9-month period, their sales was around 600 crores. That is equal to the whole year sales of FY18. So I think they should end the Q4 and FY19 with a sales growth of upwards of 40%. And if you look at their capex guidance also, they have upped their capex guidance for the next 2 years also. Like they are going to do around 100 crores per year kind of capex. And their new plant at Dahej, they put up in last April. They have ramped up to around 75% capacity utilization, and this is just one unit. And the Dahej plant has a capacity, like a potential capacity of around 1 lakh tons. So there is a long runway in this new space also. And amines as a space, if you look at the industry, 90% of the market is only 2 players, Alkyl Amines and Balaji Amines. So there is a strong moat because both these companies are making ROEs upwards of 25%. So going forward also, I think the moat should continue. And looking at the clients, agrochemical and pharma companies, both of them are doing well. So I think the growth should continue. So if you look at the valuations wise, it's currently trading at around 18 times FY19 expected earnings. While going forward, we expect around 15 to 17% kind of earnings growth, and for ROE of around 25%, and we are expecting a good cash flow to fund the upcoming capex. I think it's a good time to buy the amines companies.
Okay, how has been the historical performance of these companies in terms of their financial performance?
So, with respect to Alkali, if you go back 10 years, 5 years and 3 years kind of revenue, 10 years revenue has grown around 15-16%, PAT has grown around 20%, and ROEs has been always on the upwards of 20%. So, being in the chemical space, there is an inherent risk of raw material fluctuations. Their main raw materials like methanol, acetic acid, methanol is purely on the imported. So, raw material fluctuations will impact margins, but long run average they were able to be profitable, and they are dividend paying companies. So they pay out around 25% is a dividend payout, and management has a 30-year track record, and management holdings, the promoter holdings are around 70%, so with no pledge. So management quality is there, coupled with last 30 years there has been only 2 players and they have 90% market share. So there is a strong technical expertise needed to produce both these kind of products and derivatives also. So I think the ROE should maintain. So that's the main focus we are factoring in.
Okay, so that's the view that's coming in. HUL, Marico, as well as Alkali, as well as Balaji Amines is something that's been spoken about as far as the stocks that you need to watch out as far as this earnings season is concerned. Second, we asked them since it's the large caps which have managed to rally significantly and not the mid caps, at least in this fiscal, which is one large cap that our guest will like to recommend that you should be at least holding that for at least 1 year. So more like a positional bet. Foram, which are the large caps that you've recommended to your clients that hold for 1 year because you see value coming in gradually? It's a positional bet.
Yeah. So as you rightly mentioned, the entire large cap space have been rallied compared to mid caps and small caps. So we feel that Yes Bank is one from the Nifty 50 large cap stock which has not performed much. I mean, of course, it has fallen from the heights, and from like 170 levels it has risen a lot, but then there have been so many problems in this stock that I think there is more room for it to grow, because if you see the entire bank Nifty and all the private banking sector stocks, they've been all trading at their lifetime highs. So if you compare to the other private banks, Yes Bank haven't been rallying at its 52 weeks highs also. So I feel now that all the problems are over, there are no divergence which have come out in the RBI's report. We have a new management at the helm, and probably the worst is over. Whatever exits in the top management level is there, all has been sorted out. So we will not see these kind of problems going forward, and if we have 1 year's time for a positional bet, I feel Yes Bank is something that we should even acquire after the kind of steep up move it has seen. Probably whatever those IL&FS whatever they have given lended and all, that needs to be wait and watch, because even NCLT has said it cannot be put under the NPAs and all. That is one thing what we need to watch. But then again, if we look at the loan book growth and the NIIs and the CASA ratio, all is fine. We have no problems in the operations of the banks, and now that it's supported by a good management and everything is good in the bank, I feel that Yes Bank should be betted for 1 year's
Okay,
time.
it fell significantly because on corporate issues, because of this thing, but operationally, do you think that the financial performance will improve going ahead, given the fact that other banks are also doing well?
Yeah, I feel it's going to improve, because CASA, as I said, CASA ratio has been growing phenomenally, and then loan book growth has been again growing at more than 35%. And secondly, if you see, I think now that the interest rates have come down, the NIMs and all, for all the banks across the sector is going to report healthy set of margins also. But where does Yes Bank takes the cream is because on the valuation side, we know that all the private banks are going to report good set of numbers, but the room of upside left for say HDFC Bank or a Kotak Bank or even ICICI or Axis, they've all rallied significantly from a very long time. So Yes Bank did not contribute to that rally when they were rallying. So I feel that we still have good room in Yes Bank.
Okay, Dharmesh, which stock you believe that will rally?
See, apart from HUL, which I said, so if I have given a second choice, so I would be buying Maruti.
Okay.
So it would be a contra call. I know there has been production cuts. It may continue for 1 more or 2 more months. But if you look on the road, so what has happened is car market, I mean, four-wheeler market for the car sales, passenger car sales, won't be expanding I mean, 2-3% would be the market share expansion. But what will happen is Maruti would be eating back into the market share.
Okay.
So, because Hyundai doesn't have any launches, Toyota doesn't have any launches, Nissan doesn't have any launches as of now in that segment. Skoda is, already lost it. So, Ford again is not there. So, Mahindra has been trying hard, not successful. Tata Motors again has tried too many times, not so successful. So, this entire market share is going back to, and they are coming up with new models and launches. They have been remapping themselves consistently. So, now if you look at the new Brezza or Swift or even WagonR, so their look and feel has changed, and it's more of a classic kind of a thing. So, you will see lot of cars on the street. So, I think 150 lakh per unit kind of a run rate they are likely to maintain. There may be a couple of ones which may dip to 130 or 135 kind of figure, but that should be the time to accumulate stock. So I don't see this stock falling beyond 6,500, 6,200 on the downside. So margin of safety is there, and by the time of October, November, you will see the numbers again flowing back into the Maruti and company picking up. So from a year's perspective, I do see Maruti trading at around 9,000 kind of levels by the time we end FY20.
Okay, so Maruti is something that is being spoken about. Yes Bank, what about you, Senthil?
So we like DLF in this space.
Okay.
If you go back 3 years, their company had debt of around 25,000 crores. But fast forward, I think with the promoter stake sale in their commercial arm, plus the latest QIP, I think they are going to be net debt free from FY20 onwards. So on the balance sheet wise, they have cleaned up. Now they have a strong balance sheet. Coming on to the cash flows, the second important point with respect to the real estate companies, they have 12,500 crores of completed inventory. So quarterly now they are doing sales of around 600 crores. So the next 3-4 years, I think they should be able to liquidate the inventory at no cost. So the cash flow side, they are very much comfortable in funding the new projects. So with these two main points, valuations wise, with the embassy REIT listing, I think there is more transparency with respect to the valuations of the commercial assets also. And DLF has around 66% stake in the DLF Cyber City, the main commercial arm. So we are also quite positive on the entire commercial portfolio, either be DLF or the players like Prestige Estates also into the commercial estate. So valuation wise, on a SO2P basis, our intrinsic value would be around 240-250 rupees thing. So that is around 30% kind of upside potential, and that's the reason I think we are factoring in for a DLF for a 1 year play.
Okay, so that's been spoken about. DLF, Yes Bank and Maruti are the three stocks that have been spoken about as a 1 year play. The next stock we want to talk about is Escorts, and if you look at the numbers that came out, the monthly sales numbers this time around, rather disappointing, especially on the tractor front, be it an M&M, be it an Escorts or be it VST tillers. So tractors as a space is losing traction. Is there more pain in this sector, or is there a tractor stock that you would buy? Let's talk about Escorts. Sindhil, I'll start with you. What did you make of the numbers, and do you think that Escorts valuations have now started catching up with it?
So first on the industry level, like you mentioned, over the last 4 months, industry has been degrowing. But I think last 4 years, the industry has grown at around 16-17% kind of level. So now over the next 1 year, they will be growing on a high base. So we have to take into that effect. Plus, coming to Escorts, they have grown higher than the industry over the last 3 years, because their sales growth CAGR was around 23%, and they are able to garner additional market share also from the other players, because their new launches in the compact segment has done well. Plus, they are quite strong in the north, but north and the central, now their market share gains in the southern and western markets also enabled them to grow faster than the industry. But coming on a high base, plus a lot of issues with respect to the farms and things like that, I think we have to wait and watch over the next 2 months how the macro issues pan out, because whether the current dip in sales is a temporary or it's like a structural 1 or 2 years kind of thing, we have to wait and see. And particularly with respect to the sectors, M&M is a major player in the western and southern markets. If the southern markets have been degrowing at a faster rate, so any further deterioration in the southern and western markets will increase the competition as a whole, and margins may get impacted to do that. So we have a neutral view on the industry as such.
Okay, Ramesh, you all have active coverage on Escorts. What have you all told your clients to do post seeing all these numbers?
So we have been advising to book profits. I think the valuation is fully valued there. And what happens in a commercial vehicle space is 2-3 years of a good growth, and it has been a stupendous growth for the last 2-3 years. So the base has become very high, and you don't change commercial vehicles every day. And as far as tractors are concerned, the land is limited, right? So whatever is a farmland in India, it is not growing.
Yeah.
It is same. In fact, with technology, you need less tractors to till the same area of land. So that's a structural issue with this entire segment, and 3 good bull run has been there. What Scots had an advantage over others. They were able to garner the market share lost by M&M and other players. So even now that is stemming. So market was in a consolidation mode. For FY20 we don't think market to grow at all. In fact, we are penciling in a 5% degrowth in the industry sales. FY21 also we don't see it going too much. So it's a down cycle for the entire segment, and it's trading at 22-23 times of PE multiple. Company is good, it has turned around structurally, everything is in place. But at this current valuation, I don't think there is any scope for further re-rating of Scots. So at best it can stay here. They may continue to
will this pain continue for M&M also? Are they facing, or are they secured because of the auto sales?
See, M&M is a very diversified play. So it's a very big conglomerate. So it's very difficult to, just a segment cutting into the valuation of others. But that again is, a dragger for M&M. That is the reason why the prices have not been able to go up. So M&M, there are so many moving parts, be it defense, be it automobile, be it commercial vehicles, be it passenger vehicles, and they are coming out with new launches. So let's see how it plays out. So M&M would be a different call altogether.
Okay, what about you, Foram?
We have a buy call on Escort, and we feel that the price have corrected. I mean, the stock price have corrected significantly. And if you look at the monthly sales data, of course, the entire tractor industry has not been doing good. But despite that, if you look at the exports sales, it's maintaining 100% above exports growth. That is very good. When other companies are not able to have good export, Escort is able to garner more than 100% export growth. So that is one thing very good. Secondly, we feel that the liquidity crisis is over, and that is why the demand would be demand is just going to be back on the cards. And during a time when there was liquidity crisis, when company was able to post such good numbers, we feel ongoing demand would be healthy. Then if you look at the MSP prices also have been increased for all the 22 crops significantly. That would also lead to a demand from the rural area. So as far as demand is concerned, we don't see any sluggishness in the demand side, and that is why we feel that the fact we have got a good opportunity in Escorts to buy at current levels, it augurs a good buy currently, because earnings are going to be good, which is reflecting in the auto monthly sales numbers. Demand is going to be healthy, so nowhere we see any concerns in the stock, and that is why we feel Escort augurs a good buy at current market price.
Okay, so we got 360-degree view as far as Escort is concerned. Two of our guests don't believe that Escort should be accumulated, but Forum here is indicating that there are positive traction yet left on Escorts. And finally, one of the companies that came out with numbers till now was Delta Corp. Pretty strong set of numbers, growth on the top line, bottom line. Even the margin did manage to expand significantly in trade. But is it an attractive bet? What's the future of gaming in India? Dharmesh, what did you make of the numbers? Is there more potential upside on Delta Corp? It's one stock which has been spoken about, that a lot of HNI investors are there, but somehow it's been stable at this level. What's your sense?
The reason for it being stable is because of Daman Casino. So that license is not there. 16th April again there is a hearing by the court. So let's see what comes out there. But apart from that, all other businesses have been doing well. The cash flows has been too robust. 40% kind of an operating margin is there, and this time the margins have improved. And the way offline gaming segment is picking up, like Adda 52 they acquired, now that has also delivering results now. They have acquired a few of the cruises out there, so that business will open up a new avenue for Delta Corp. And they have identified the businesses where they don't think they are the core businesses. So for example, Advani Hotels, they had a 25% stake, then there are couple of properties in Sikkim, and so 236 crores is that valuation which they would be diluting. So that cash flow will again come into the play. Goa license you have to renew every year. So onshore, if it goes away, so they already have a plan for offshore, and that they are expanding. So it can be a twin advantage. Onshore is also there, offshore also comes into play. And the one thing happens, then it will be a complete re-rating for Delta Corp.
Okay.
At present set of numbers, the way it is delivering, we expect 20 to 25% kind of a CAGR for next couple of years on the earnings front, and SOTP based kind of a valuation with all the properties putting into place, where we have given discount to Advani hotels and all. So 315 is the target price for Delta Corp. So this, as you rightly pointed out, it has been sluggish. It may continue to be so. But we do think it's a very good investment bet. The way entire online gaming segment is panning out, even IPL, if you Dream 11, all things. So these all are getting streamlined in India. Even laws are getting enacted to get it more legal perspective. So this will eventually favor Delta Corp.
Okay, what about you, Foram, Delta Corp?
Yeah, we feel that result has come nice in every parameters. Even margin increment has been there steeply, and bottom line on a yearly basis has grown by 85%, which is very good. And the fact that it enjoys a monopoly status, in the gaming zone, in the listed space. So we feel that Delta Corp augurs a very good buy. Of course, the headwinds of license acquiring and all is there, but we know it has done all the right, acquisitions. I mean, tying up with the crews to expand the gaming zone and everything. So we feel that top line and volume growth is going to be there in the company, and we feel that though the company has been growing at a good high base, still it will continue to grow at 25% CAGR on a bottom line, which is very good, and that is why we feel that currently the stock is in a consolidation phase, where it's not seeing much up move, obviously because of the licensing thing and all. So currently you can buy for a good 1-2 years time, and you can see good upside from here on.
Okay, what about you, Senthil?
So the Q4 numbers were strong both on the offline and the online platforms also. Especially the margin improvement in the online platform was quite substantial in Q4. So like Dharmesh mentioned, their strategic investments they are doing both on the offline and online, and their strong balance sheet. I think the company is quite good, but one major risk we are seeing is their Goa's gaming policy or casino policy. So that has been postponed 2 times, and lastly the extension given by the government for next 6 months. So we have to see how the shifting of this offshore from this river to the onshore takes place. So the last policy guidelines they mentioned, like they'll be giving 4 years time frame for this offshore gaming vessels to move to the onshore. So that is slightly we have to wait and watch how the government policy turns. So that's a major risk as such. But company wise, I think gaming in India is just in the nascent space, both in the offline and online. So industry wise, I think they are the major market leader and they are the pioneers in developing this market. So as such, promoters and business, we are quite positive, but the government risk license is what the major risk we are factoring here.
Okay, that's the view that's coming in on the final stock Delta Corp. But with that, we are timed out on this edition of Hot Money. Let me thank all my guests for coming in. Dharmesh, thank you so much. Foram, Senthil, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.